So you find the investors that that business plan really has an impact on them, and the
It's critical.
description. Yeah, it's critical.
Absolutely critical.
Before the show, we were talking about how you go about putting this information out to the investment community. Why don't you tell our viewers about that?
There are several ways of doing that. It's a highly regulated field too, legally regulated in terms of sending this material out. A technique that we use quite often is the technique of an accredited investor. An accredited investor is someone who is demonstrated either through an income level or through holdings of assets that if he or she would invest in a project, the person wouldn't be investing his or her life savings into and that's not something that you want, because a lot of times in venture capital undertakings, the product might not succeed. So you certainly don't want someone putting their life savings into it. Now, how do you find the accredited investors? There are various ways of doing that. One is through word of mouth networking, and that's one of our major techniques. But also, there are secured sites on the internet where the access codes are given only to the accredited investors. Now, an inventor who would be able to get onto one of these networks, like AceNet, or there are several of them, and there are even some private ones coming out now. An inventor who would have access to that market would then be sure that his idea or her idea is going out to these accredited investors, and that's just what the inventor usually wants.
What kind of response do you get to the investment letters and that?
The response is usually very quick, and the responses are either you won't hear anything, which is not uncommon. You'll hear someone asking for more information, which sometimes means that they're ready to meet the inventor, or you'll get a positive response, and sometimes you get the positive response very quickly as well.
What kind of success rates do you see overall when you develop a good business plan and they have a decent product? Are the success rates encouraging?
Yes, they are. This time is a good time for doing venture capital work, and in terms of percentages, I would say, well, we are somewhat picky about which projects we will undertake, but I think our success rate is, in terms of raising money, I'm sure we're over 90% on the projects that we've tackled.
That's very good, yeah. So you've done your initial homework up front, and then things seem to flow pretty well on the back end at that
exactly.
point there.
So it looks like a reasonably good product. It looks like it's like the proposal for financing is realistic. Why? Sometimes that makes it an easier sell.
Let's talk about moving from that first-tier financing. Now, we talked about second-tier financing, and maybe just give our viewers a little overview about what happens between those 2 points and what the transition is into second-tier financing.
The inventor will obtain the first level of financing. Everything will be going along very well. The company will be making a little bit of money, maybe not as much as the inventor wants, but it'll be operating profitably. The inventor, being a dedicated, diligent person, goes with this and keeps trying to expand it, but then hits the wall. And the wall is where all of a sudden one day an order comes in, or a few orders come in, and the inventor's company is not able to fill the orders. So now here you are. You have a good idea, you have a good track record for 4 or 5 years, and now you have orders or contracts that you cannot fill. And that's where second-tier financing comes in for the purpose of expanding the business to match the expectations that have arisen after the first few years of operation.
Yeah, in your experience, how long does it take to get to that point for some average companies?
For some internet companies, that can happen in 3 months or less, but probably for the traditional business, 3 to 4 years, sometimes 5 years.
Okay. Do you see a lot of it occurring, growth in that period tending to be domestic, international, or both? Or is it?
I would think that most of the non-internet companies that we deal with are East Coast, Great Lakes region. Not many have been international.
This is your host, Randy Knotson, with our return guest, Rick Johnson. Rick, thanks for coming back again.
Thank you, Randy.
Last show, we were talking about the second-tier financing and what happens when an inventor moves into second-tier financing after, in case of an internet company, 3 or 4 months of high-speed growth, or of a traditional company with maybe 2, 3, 4 years of regular growth. What happens at this point?
This is the point in when the owners of the company and the inventor is often most frustrated, because here the inventor will have had a few years of having a successful company, and the company may not be as financially successful as the inventor wishes, but usually it's enough to make ends meet and to have some innovation and development of the product. But then all of a sudden, the company will be flooded with orders or contracts that the company is just simply not able to fulfill. And this becomes even more frustrating and acutely dangerous, really, to the company, because now you're in the unenviable position of having orders that you cannot fill, maybe even having a small plant or a small warehouse that is just not large enough to fill the orders that you do. And this is an ideal situation for trying to help a company get over the wall through additional financing. For example, you may have a company that, let's say, it's operating at a margin of $80,000 to $100,000 a year, and it's been doing that for 3 or 4 years. The company is based upon the invention of one person. That one person is now president of the company. And all of a sudden, through his good networking techniques, the company has a good reputation and could even be a leader in that particular field or industry. And with good marketing, the competitors may not even know that the company is on the verge of hitting the wall. There'll be orders, and the company just can't fill them. So this is ideal for us because we can then put a business plan together which shows a history of success. And I mean, it doesn't have to be stunning success or stellar success. It just has to be success. Because then, if you're operating at a certain margin, let's say you double the capital. You get a warehouse which is twice the size. You get a plant that's twice the size, or you have an assembly location that's 2 or 3 times the size of what you have. As long as you have the orders to justify that, why, there you have a fairly good likelihood that the margin would remain at the larger scale. Mm-hmm. So, for example, if you're looking at trying to double from $80,000 to $160,000, and you might need $400,000 or $500,000 to do that, mm-hmm. Why, you can see just from the simple mathematics there that for a venture capital person, that would be a very attractive opportunity because you would probably have not only a return on that investment immediately by filling those orders, but also you would probably end up retaining an equity position in the company, which then would continue to grow in value.